So this week we're going to be talking about how to quickly say yes or no to multifamily investment opportunities. How to quickly say yes or no to multifamily investment opportunities. So this is a interesting topic because as we acquire properties or as we look at deals, a lot of times we'll have to shift or make very quick decisions based on, just where things come in. Deals come in that weren't expected, or, off-market deal comes in and you have to shift gears and make a decision really quickly. And so it's important to understand kind of how to do that. And so we're going to go over a few of those things today. So the first thing we want to go over, the first thing that's going to help you to make a quick decision is going to be having a set criteria. I know we talk about this a lot, how to set your criteria, how to pick where you're going to invest. It's very, very important when thinking in terms of how to make quick decisions, because if you already have your criteria set, it's going to very quickly allow you to disqualify or qualify a deal. So that is going to be your first step in making a quick decision. So criteria, well, I know we've gone over this, but I want to go over it again, just make sure everybody understands what we're talking about. So your criteria for multifamily, for what we invest in, it's going to be your vintage, which is your year. Your deal size is usually going to be one of those criteria. How much, how big of a loan can you get, based on your loan guarantor or yourself or whoever is guaranteeing the loan, your liquidity requirements there. So, where is that capped at? How big of a deal can you purchase based on that? And then how much money can you raise? That's going to kind of set those numbers for you. So vintage, what year, how big of a deal, what size as far as dollar amount, how many doors. We don't necessarily look at that as much as how big of the deal is. And then you want to look at what class. So are you, looking to do A class, A plus, B, B plus, or C class? Are you doing value add? Or are you doing, just cash flowing assets? So once you have all those figured out. Oh, and the other one that I wanted to mention was region. What region are you going to invest in? And it's important to have these because it helps you narrow down what you want to go after, or what you want to spend time underwriting and visiting and touring. So if you have those lined up, if you don't have them lined up, you're going to be drinking from a fire hydrant with deal flow, because they're coming from all over the place. I mean, you get one in Maine, and one in California, and one in Arizona, and one in, Oklahoma, and one in Louisiana, and you want to invest in the Southeast. So you filter any deals that come through from the brokers based on region where you're going to invest. And then the ones that come through in your region, is it the vintage that I want? Yes or no? There, you just made a quick decision. Is it the size of deal that I want? And you're going to get the guidance on that right from the broker immediately when that deal comes out. Say, what's the guidance on this? And that'll help you say yes or no. So you've made another quick decision on whether you're going to pursue the deal. And then what class it is, that's already going to tell you whether you want to pursue that deal or not. So now that you've already made those multiple quick decisions, you can decide whether to put effort into underwriting this deal. And really, you have to do it that way, or else, if you underwrite every deal that comes across just to see if it might make sense, there are probably some deals that are outside of your criteria that would make you money. The problem is you'll be so spread out and not focused that it'll dissipate any efforts that you have. So you want to make sure you stay focused. Just pick your criteria. You can always adjust it. You can always change it, but version 1 is better than version none. So you want to be sure to pick those right away. Apologize, I just got a text from Dan. So he was texting me during my webinar. But so the first step is set your criteria. The next step is quick math to qualify return. So we've gotten it from the point where, are we going to underwrite this, to yes, we are going to underwrite this. And so this is a very important step, and I'm going to slide over some underwriting from a deal that we just closed on. And can everybody see that spreadsheet? Just holler in the chat if you can see it. Yes, okay, good, excellent. All right, so this is kind of our underwriting model, and so some of the things that we're looking for. So we've put in purchase price, we put in all of our pro forma. So there's a lot of work that goes on to get it to this point. And we're going to talk a little bit about working with professionals in your industry to help you get to this point. But we want to look real quickly at some crucial numbers that will help us decide whether we want to move forward with this deal. One of the very first ones that we're going to look at is going to be cap rate, adjusted trailing cap rate. Okay. This is a deal we just closed on in the Charlotte submarket. And so this is already a deal that's closed out, so I can share the underwriting on it. But adjusted trailing cap rate on this one is 4.7. Okay, that's in a good range. I'm going to check my market sales and just make sure that it's in range. As if you're buying in a market, you should already know what the market cap is. I will say that that's adjusted quite a bit during COVID because of the interest rate drop. So I've seen probably a 30 basis compression on cap rate across the United States, with exception of, California, New York, and maybe Chicago or something like that. But basically, that's what I've seen in our region, in the Southeast and in Texas, and even in Phoenix. So sometimes even higher than that. So cap rates have come down. They've compressed from where they were pre-COVID. I know that sounds counterintuitive, but it is what it is because of interest rates. So we'll see what that does this year. But right now, I want to check and make sure my cap rate is within market. If it's not, then you're overpaying for a deal. And that does happen sometimes because if it's a very underperforming asset, they're not doing a good job, they're not getting the revenue, and you think you can. Sometimes you'll have to pay a little bit initially for the value add in operations that you're going to achieve. But that's the first number I want to look at, is the trailing cap rate. The second number I want to look at is my IRR right here. So my returns to my investors. I want to make sure, first of all, that I'm paying what I want to pay. Okay, it's in range based on the income that the property is achieving. And then I want to make sure it's giving the investment that my investors are going to expect. Okay, so these are cash on cash and LP IRR. So IRR is the rate of return with the time specification. So, if you get invest $100,000 and you get 200,000 back on that, your capital return plus another 100,000, you'd say that's a good return. But if it took you 20 years to do that, that would not be a good return. That would be a bad IRR. So IRR is the return with the time factored in. And then your cash on cash is just that. It's your annualized cash on cash. So this kind of shows what each year is going to produce. And so we're checking to make sure the cash on cash is going to, that the property is producing is able to pay returns. And then we want to check also on the purchase price. This is something I'm going to take you to another site here in a minute. The purchase price. So we looked at cap rate. So usually these two, the purchase price and the cap rate, are going to go hand in hand, but I'm going to show you another thing that are going to look at. And that is going to be right here. This is a different property, but I can pull up. Yeah, I'm going to just look at this. This is another property that we closed on this year in the Raleigh submarket. This is CoStar, as you can see. It's an invaluable piece of software. It's also very expensive, but it's invaluable. And I'll show you why. Okay, so I've done my underwriting. Okay, I've made the decision based on criteria that I want to underwrite this deal. And then we've gotten it underwriting. I'm going to we're going to go back and talk about underwriting in a minute and how to get there quickly, how to make quick decisions. But then we've made quick decisions. We've looked at the cap rate. It looks good. We've looked at the cash on cash. It looks good. We looked at the IRR. It looks good. I want to check the sale price and make sure that I'm paying in range for this property. And so I'm looking at both price per unit right here in this column over here. And hopefully everybody can see the CoStar page, but the price per door that the people paid for it. And then we're going to look at vintage and make sure I'm looking at a comparable vintage from what I'm looking at. You don't want to look at a 2017 and be like, oh, they paid $225 a unit and I'm only paying, $200 a unit. So I'm getting a good deal. Not if you're buying a 75 vintage. So you just make sure you're comparing the vintage. And then you can look on the map and see where they're located, make sure it's in the same micro submarket. You want to look at the sale date because, obviously there's a big difference between 2019 and 2020, as we can all attest to. So you want to make sure it's a pretty recent sale. So you can see these 2020 sales are pretty recent. And I can check and make sure that we've come in or we're buying at a comparable sale price. So we don't want to make sure we're not overpaying. And all this plays into when you go to your investors, you want to be able to say, look, these are the sales comps and we're getting it for this basis per door. And so it's in range of the market. We're not overpaying for it. So you can see it's a good investment. So that's very important to look at. So that's a very quick way to qualify the property. So I did cap rate, purchase price, IRR, cash on cash. And there's some fine tuning and stuff once you've made that final decision. But once you've made that quick decision on, okay, vintage or criteria is good. So we're going to underwrite it. Underwriting is good. So now I'm going to tour it. And then at that point you tour it to get FaceTime with the broker. And then go from there. So let's look I want to show you a little bit more about CoStar. CoStar is one of our sponsors for the summit. But I want to show you some of the great things that this does and how we use it. So we look at vacancy rates. You can see all of the occupancy rates, vacancy by bedroom, market rent. So you can see all the different metrics that you can get at the click of a button. So this is very helpful just to see, really quickly, if you're trying to make a quick decision, how this property is performing and how it has performed historically. Okay, so I'm gonna go back here. All right. So the next thing we want to talk about is utilizing professionals in your network to evaluate the opportunity. One of the big things that we do, we have someone that does a lot of the data entry for us and initial underwriting, because that's not time well spent for myself or for Danny. We would it's just data input and make sure everything's correct. We're better off reviewing the deal and looking at some of the things that we just looked at. So we have somebody that does that for us on short notice. So we can just send it over and it happens, usually within a few hours. And then I can pull that underwriting up and look at those metrics that I just talked about and make sure that deal is within the range of returns that we expect to see. Again, you're going to be able to adjust some things here and there, but it needs to be in the range. Once I know it's in the range that it's going to work, we just need to work on a few things. I'm going to send it now to my property manager, the head of my operations for our property management company, and they are going to provide us with a pro forma. The pro forma is going to be, your expenses, payroll and whatnot for the property, as well as a rent analysis. So it's going to be a little more detailed than CoStar does. It's going to be based on how they think they can operate the property and where they think they can perform at. And we like to do that because they can set the bar that they can achieve. So if we set the pro forma only, then it doesn't give we could be setting them up for failure. So we want to make sure that they're on board with the business plan. So we let them submit to us, and then we check it with our data and make sure it's good. So the quick decisions to review again. We're going to be talking about criteria. If it meets the criteria, we're going to move forward. If the underwriting returns are good and the sales price are good, then we're going to move on to the next stage. If we're going to get the pro forma, and I did get out of sequence the tour, that's going to come after I get the pro forma. Once the pro forma comes in and it's still good and everything's working well, then I'm going to move on to tour. So you want to make sure you use people in your industry, your property manager, or other brokers. You can talk to different people. Make sure you do your due diligence at this stage before you spend a lot of time. Because again, if you just go and tour properties before you've made these decisions, these very quick decisions, then you're going to be traveling all over the place for deals that you're not going to likely get, or ones that didn't even work in the first place. There's going to be deals that work that you aren't going to get. That happens all the time. It's part of the business. But you don't want to be running around touring deals that won't even work for your return metrics. So that, you want to make sure that you've evaluated everything, that you are able to make quick decisions. And the reason you want to make quick decisions too is the next point: when to deviate for the right opportunity. There's many times you have fully marketed deals, right? And they, you get the email, you have the OM, the offering memorandum, you have the T12 rent roll, and you've got hundreds of people looking at it. That's your normal deal. And that they usually have a set CFO call for offers date on those deals. Okay. So we know what time frame we have, and we have usually about 30 days before that offer is going to be due. However, every once in a while, and this happens quite often, actually, a broker's call you up, say, "Hey, I've got a deal, but I've got to get a response in 48 hours. It's off market. The seller's willing to sell, blah, blah, blah," whatever the story may be. And so you may be working on 3 or 4 deals at the moment, and then this deal comes in and you need to assess it. You need to drop everything that you have and put this one in the fast track to the front of the line and try to get it underwritten, and to the point where you can submit an LOI in a matter of hours, really. So usually within 24 hours, we can do that. So it's very important that you have the system in place, or be able, whatever your system is, you need to be able to make very quick decisions on whether, you can submit an LOI. And I know some people think, oh, well, it's an LOI, so just put an LOI on it and we'll figure it out later. That's one way to do it. That's not our way of doing it. And the reason that we don't do it that way, we want to make the decision whether we can pursue the deal before we ever submit an LOI. We treat LOIs like it's a PSA, a purchase and sale agreement, because we want our word to be our bond. We want anybody that transacts with us at any point in time to be very pleased with the whole process, with the transaction. So we don't want to be wishy-washy. We don't want to slap an LOI on it, and I haven't even had a chance to really underwrite it, but I want to go ahead and say that I'm interested with an LOI and then back out of the deal a couple days later, because it didn't work. And that makes you look wishy-washy, and you're going to lose confidence with your sellers and your brokers. So I know it's just an LOI, but that's the way we treat it. Not everybody does that. I'm not saying that doing it another way is wrong. I'm just telling you that's the way we do it. And it's worked well for us. And so we get a lot of repeat sellers that come back to us and are very willing to sell to us because of the way we move rapidly and smoothly. So very little hiccups, very little wishy-washy. We want it to be as smooth as possible. So that is basically how we come to that point. So, we've toured the property. You get this off-market deal and you need to make a decision quickly. What we do is we have a partner call when we're trying to decide whether to put a PSA, or usually best and final round of offers, or an off-market, just a PSA. We'll have a partner call after we've run through probably 4 or 5 underwriting versions, and changing different things and working on the metrics. And then we'll have a partner call with the 3 of us, Dan Handford, Danny Randazzo, and myself. and we'll discuss it, and we'll talk about it with all three of us on a Zoom call with the underwriting pulled up, and we'll say, well, what about this? And what about this? And we'll kind of work the deal together with all three minds working together. And we found that to be the best way, because we all have a different thought process. And then we make a decision right there on the phone, and those decisions are, are we going to go hard money on this one? Do you think that, this equity amount is good? We can raise this amount. Is this a good purchase price? We're discussing making sure that everything is good, that all partners are in agreement to pursue the deal at the terms that we have come up with. Because up until this point, it's been myself, and then I involve Danny when discussing the underwriting, and then we bring Dan in at the end, and then Dan takes it over to do investor relations once we put it under contract. So that's kind of the way, and then Danny steps up more and works with the bank during the closing process. So that's kind of the way we work it. But we want to make sure we make the decision. And sometimes you can't just narrow it down to criteria. One very important thing when making decisions is your gut, or whatever, intuition, whatever you want to call it. It's very, very important. You don't want to be ever emotional about a decision. It's a beautiful property, so I just want to, I know they want a little bit more for it but we'll make it work. Don't ever get in that situation. It has to be cold hard facts. But then there is this thing, intuition or gut. We've had deals that made sense on paper, but it just didn't feel right. Something about it, whether it was collections or bad debt that was bad with the property, but we just didn't have a good feeling about it, and we've walked away from the deal. And the deal made good sense on paper, and we could have purchased it. So, don't discount intuition or gut. But then there's also those decisions where there is risk on the line. Everything is risky. Walking out your door in the morning is risky. You can mitigate that risk by not walking into traffic. So we mitigate the risk by doing our due diligence on the property and underwriting everything as well as we can, and having reserves to overcome anything that we may have missed. But in the end, nothing is known. There's always an unknown factor. There's always something that's going to deviate from what you thought it was going to do. So there's always risk involved, but you have to be able to, take that risk. And there's been moments where, when you have, let's say, hard money on the line, and, it's a bigger raise maybe than what you've done in the past. And that's a risk, but that's where you really grow, as you just have to say, okay, we can make this happen. And then having that standard now set, let's say you put a deal under contract and it's the biggest raise you've ever had, and you've got, a bunch of hard money, non-refundable money down. Well, you're going to work really hard to raise that money. So having that already set in place, it's kind of like the burn the ships logic, the general that was invading this other country, and it was no retreat for the soldiers. So as soon as they landed on the shore, he burnt all the ships. So they had no option but to win. So that's kind of the way you have to go at it sometimes. So hopefully that will help you in your decision-making. Those are just some things that we use, but I want to take some time to go over some questions. So one question was in regards to the rehab wallet. That we talk about. Rehab wallet, it says, do you do non-recourse loans with the investment fund? So no, we do all, these are all, we are the lien holder on the property. These are single family homes, traditional hard money loans for fix and flip. So I hope that answered that question. One question is, how do you know what is the appropriate cap rate? We are looking to expand markets this year. And so as I've gone into those new markets, I've called the brokers up and I just asked them, what's your cap rate? And I'm asking multiple brokers this question, so I kind of get a feel for it. And because it varies. You can't just say, oh, a good cap rate is, a 5 cap. Well, that's maybe good in Florence, South Carolina, but it's not going to be good in Raleigh. It's not going to be good in Phoenix. It's not going to be good in Austin. Okay. So you have to know what the cap rate is in your market. So the best way is to underwrite some deals in that market and get a feel for it. You can do some high level underwriting on deals that have sold, going again through CoStar. So you can look and see some of these sales comps, and you can figure out, kind of what people are paying for it, stuff. So that's a good way to figure out cap rate. But cap rate is just a measurement tool to kind of give a feel for, where you're buying in the market. It's nothing more than that. It's just same as sales comps. You can check it by this, but it's the sale price. So, maybe the comparable units are, 195,000 per door, but this property is underperforming. Therefore, the cap rate is going to be less because it's not producing income enough to warrant 195,000 a door. The sales comps in the market do, because those properties were performing where they should be. That you can then probably get it to that point, based on your research, but the current property is not performing that way, so that your cap rate is going to be low. So sometimes that does happen, and you can negotiate to get that deal and then bring it up to where it needs to be, which is our other metric, which I'll show you. Our year one operating cap rate right there. So that's once we're stabilized, and that's where we project it to be. Okay. So it's just a matter at that point of where you feel comfortable with the deal, but that's basically where we come in with cap rate. So we go back here. All right. The offer day. Okay, what's the offer day? Call for offers. So that's going to be the day when, so if you have a fully marketed deal, so you've received the email from a broker, you've gone to the deal room, and you've downloaded the financials, and you're in contact with the broker, and you've underwritten it, and you have a CFO date, call for offers date, and so that's the date where you're going to submit your LOI. Usually, in normal market conditions on a fully marketed deal, there's going to be 30 or so people that submit an LOI on that same deal. Once you submit the LOI, then you're going to be filtered into the top 5. Sometimes I've seen as high as 10 go into the best and final, but usually around 5 go into the best and final round. So they've weeded out kind of those 30, where are the best groups and offers. So it's not just price. It's going to be, I've never heard of this group before, or, I don't like this group because they, maybe they don't do good with transactions, or they like to retrade. And this group has the best price, but maybe we haven't heard of them before. So that's how they kind of narrow that down and get you into the best and final. Usually what I go ahead and find out from the broker is, what is the cutoff to get me into best and final? We've gotten to the point where we have the reputation. He's like, well, it doesn't really matter where you submit first round. Here's my guidance, but I'm going to make sure you get in best and final anyway. So that's a good place to be. And that's built by having very smooth closings, like I was talking about before, not being wishy-washy and just submitting on everything. So that's kind of where we've gotten with that. But that's what call for offers day means. Initial underwriting. Now, somebody's asking if we use a virtual assistant for that. We do not use virtual assistants. There's sensitive information. We have to sign confidentiality agreements, and so we don't want to ever send information on deals that are off market out to somebody not within our organization. So this is someone that we know that works for us on a part-time basis right now. Just doing this strictly, but they're actually part of our organization. So you want to make sure that you're careful with that, with the virtual assistant side of things. Okay. And then we got a follow up on the question about the offer day, offers due by Friday, et cetera. What does that mean? So one thing I will mention about call for offers day, if it says call for offers are due on Friday, it's by end of business that day, or, whatever it is, December 29th. It's by end of day that day. Be sure to submit it by the end of the day, unless you've discussed it with the broker, because a lot of people, they're waiting to see where the pricing comes in at to make sure they don't overpay for it. But keep in mind that the seller is paying attention to when you submitted, and sometimes some of the sellers are pretty hard nosed, and if they can't even submit an LOI in time, how are they going to close on time? That's their mentality. So be very careful about when you submit and submitting on time, unless directed otherwise from the broker. All right. Okay, and a question: where and how do we find these properties? So that's broker relations is the best way to do it. You have to build those relationships. You just start by meeting with them, getting to know them, touring properties, and being very respectful of their time. And if they give you a deal, make sure you close it seamlessly, and make sure that they're very happy with the process. So build that broker relation. That is the best way to get deals. Another question about Rehab Wallet, about repayment time frame. Just click on the link there. Our mortgage officers will answer any questions that you have there, but we're very competitive on that side of things. Let's see. How do those steps for those looking to house hack differ from multifamily? I don't know. I'm not in the house hack space, so I wouldn't be able to answer that question very well. Got a lot of questions, so that's great. I'm just kind of scrolling down through these. One question is what depreciates the property value? That's going to be the operations. If it's not performing well, if you're not able to achieve rents, let's say we have a bad economy, okay, and in your class of multifamily, you cannot push rents anymore to compensate for inflation. Let's say you're underwrote a 3% rent increase year over year, and that's basically inflation. But let's say that flattens because of a recession, okay, and you're not able to raise rents. Well, that's gonna compress your value. That's going to depreciate your value. So that changes across the board, but really from in the last recession from A class to C class, there was only a 50 basis difference in vacancy and rental increase across the board of asset classes. So it just depends on what the situation is. Right now with Corona, your working class is being affected a little bit more than your upper class units. People that are already working from home or consultants, different things like that, they're not as affected, whereas people in tourism, service industry are more affected if they can't work. So that's been a little bit different. So, but if you have a financial crisis like we did last time in the banking, it may affect things differently. So it's always a little different, but that's how the value is affected, and debt as well. People cannot make a deal work if money is expensive. Right now it's very cheap. So that's why we've seen the compression in cap rate. Give an example of when your group deviated from the normal. Deviating from the normal the only thing we mean by that is, deviating from our normal flow of deals. So we have, our normal marketed deals, and then all of a sudden a broker calls us up and has an off-market one. We'll deviate and just go ahead and put that one to the front of the list and move the steps along quicker. And sometimes the one way that deviates is if it's off market. A lot of times we'll have to submit an LOI before we can tour the property. So that's a little bit different. So touring the property is not, in my opinion, going to make or break a deal. That's kind of like a little bit of a dog and pony, more of building relationships than anything. So, Oh yeah, Patrick had to step away. We want to answer the non-recourse. We do not do any non-recourse debt back to the rehab wallet. Ours is just fix and flip, hard money. So we're lien holders on the property. What are your absolute musts in underwriting a property in a secondary and tertiary market, especially when you can't get there given the current situation? So absolute musts. I mean, it's hard when you can't get there. I understand a lot of people don't. Secondary and tertiary, we don't really do a lot. We don't do any tertiary, and some stuff may be considered secondary, but it's a submarket of a primary market of a metro area. I mean, you have to have accurate financials, and then those financials must equal the returns. That is really the only way I could say an absolute must is you have to have the T12 and the rent roll, the trailing 12 months of expenses and income and the rent roll. So that's going to tell you your occupancy, your bad debt, your loss to lease, which is the difference between market rent and what you're achieving. Bad debt is people that haven't paid. Vacancy is units that are not rented. So all those things you have to be able to see those. All right, well, we're getting down on time, and I'm gonna skim through these questions again, and I apologize. You guys have done a great job of asking questions. So I just want to make sure I've kind of covered that. So thank you for doing a great job. I got one question on the topic of overpaying as an LP. As an LP, what's the best way to check if the sponsor is paying pref distributions from cash flow and not in reserve or capital raise? That's going to be all in your PPM. So make sure that's your private placement memorandum. So all that's going to be spelled out in there. So, and then ask questions. If you have a question like that, just ask the operator. If they don't want to answer that question, that's probably a bad sign. So should do that. How do you verify expenses and what utility landlord tenant pays for? So a lot of the verification of things is going to be once you put the property under contract and you're actually doing your due diligence or your lease audits. That's when you're going to be checking everything. You're actually looking at, what they're paying. And there's wording in the contract that says, if there's any deviation from what they represented to you, then that's a breach of contract. So, there is some safety in that, but based on the contract, but make sure you use a legal professional to do that. All right. There's some great questions, but I'm just not going to be able to answer them all. So thank you all once again for joining me next week. And I'm not sure if this is going to, okay, excellent. So if you look at the screen, we've got next week, going to be deal process from underwriting to closing for apartment syndication. So it's going to be a little different. This was about making quick decisions. I know we got a little bit into deal process, but it's going to go deal process from underwriting to closing for apartment syndication, qualifying the deal, running the numbers, touring the asset, meeting the broker, full underwriting and offer process, PSA and due diligence, and so much more. So the PSA and due diligence will get a little bit more into that. That's the contract and the time frame of all that. So be sure to tune in next week. Danny is going to be back with you next week going over that. So be sure to check in and we will see you next week. And thank you all for joining.